Hello, traders, and welcome to today's institutional market review. Today is Friday, February 20th, 2026. We will be diving deep into the fundamental and technical landscapes that are shaping the global financial markets as we head into the weekend. This comprehensive analysis is designed to provide you with actionable insights and a clear understanding of the current market dynamics, helping you navigate the complexities of Forex trading with greater confidence and precision. We aim to cover all critical aspects that could influence your trading decisions in the coming days and weeks. We begin our detailed analysis with the fundamental outlook, examining key economic indicators and central bank policies that are driving market sentiment. Following this, we will transition into a thorough technical structure analysis across major instruments, providing a complete picture of potential price movements and critical levels to watch. Understanding both fundamental and technical factors is crucial for making informed trading decisions in today's dynamic Forex market, and we will ensure a balanced perspective on both. Starting with the European session, the Germany Manufacturing PMI is expected to increase slightly, moving towards 49.6. While still below the 50-point expansion threshold, this marginal improvement suggests a potential stabilization in the German manufacturing sector, which is a key economic engine for the Eurozone. Meanwhile, the UK Manufacturing PMI is expected to soften marginally to 51.5. Although still indicating expansion, this slight deceleration could signal a cautious outlook for the British economy, potentially influencing the Bank of England's future monetary policy decisions. These PMI figures offer early insights into economic health and can impact currency valuations. As we move into the US session, the core PCE price index and the latest GDP figures are set to become the primary volatility drivers for the day. These two economic releases are highly anticipated by market participants as they provide critical insights into inflation trends and overall economic growth in the United States. The Federal Reserve closely monitors the core PCE as its preferred inflation gauge, while GDP data offers a broad measure of economic output. Any significant deviations from expectations in these reports could trigger substantial movements across all major currency pairs, particularly those involving the US dollar. The US GDP is expected to slow significantly, with projections indicating a drop from 4.4% to 2.8%. This substantial deceleration in economic growth, if confirmed by the official release, could have a notable impact on the US dollar in the short term. A weaker GDP reading typically suggests a less robust economy, which can diminish investor confidence in the currency. While some forecasts for Q4 2025 GDP were around 3.4 to 3.5% growth, and other models even suggested a stronger acceleration to 5.2%, the current expectation of 2.8% represents a considerable shift. This highlights the inherent uncertainty in economic projections and their potential to surprise the market, leading to increased volatility and potential dollar weakness. The core PCE price index remains the Federal Reserve's key inflation indicator, making its release particularly impactful. Stronger than expected PCE data would typically support the dollar, as it could lead to expectations of the Federal Reserve maintaining a tighter monetary policy or even considering interest rate hikes to curb inflationary pressures. Conversely, weaker than expected data could pressure the dollar, as it might suggest that inflation is under control, potentially reducing the urgency for aggressive monetary tightening. Inflation plays a crucial role in interest rate decisions, with central banks generally targeting around 2%. Higher inflation may lead to interest rate hikes strengthening the currency, while low inflation could result in rate cuts weakening it. Therefore, traders will be closely watching this report for any signs of inflationary shifts. In summary of our fundamental outlook, markets remain highly data-dependent heading into the crucial US session. The upcoming releases of the core PCE price index and GDP figures are poised to be significant catalysts, with their outcomes likely dictating short-term market sentiment and volatility. Traders should exercise caution and remain vigilant, as any unexpected results from these key economic indicators could lead to rapid and substantial price movements across various asset classes. The interplay between inflation data and growth figures will be paramount in shaping the market's perception of the U.S. economic trajectory and the Federal Reserve's policy path. Now, let's shift our focus to the technical structure of the EUR-USD pair on the H4 chart. The pair recently rejected the significant 1.2 major resistance zone, a level that has proven to be a strong ceiling for price action. Following this rejection, EUR-USD is currently forming a series of lower highs, indicating a clear shift in momentum towards the downside. The current price is observed near 1.1767, positioning it well below the previously tested resistance. This technical setup suggests that sellers are gaining control, and the market is struggling to sustain any upward movements, reinforcing the bearish sentiment that has been building in recent sessions. Our primary scenario for EUR-USD points towards a bearish continuation, with a probability estimated between 60% and 65%. This outlook is supported by the current price action, which shows the pair consolidating after breaking below the 1.1885 level, with bearish momentum evident as the price firms below the Bollinger Band's midline and the MACD remains in negative territory. A decisive break below the critical 1.174 support level would likely open the path for further declines targeting the 1.165 level. This aligns with analyses suggesting that a sustained move below 1.1765 would lead to deeper losses towards 1.17, confirming the strong bearish bias. The alternative bullish scenario for EURUSD, with a lower probability of 35% to 40%, would require a significant reclaim above the 1.188 level to invalidate the current bearish structure. However, the prevailing market structure currently favors controlled downside pressure, suggesting that any corrective rebounds are likely to be capped by resistance levels. Some analyses indicate resistance at 1.1885 and 1.2, which would need to be decisively broken for a bullish reversal to gain traction. Given the current technical setup, the path of least resistance appears to be to the downside, and traders should remain cautious of potential selling opportunities on rallies. Moving on to the GBPUSD pair, the H4 chart reveals that the price recently rejected the 1.385 level, a key resistance point that is held firm. Following this rejection, the pair is now forming clear signs of distribution, indicating that sellers are actively entering the market and pushing prices lower. The primary direction for GBPUSD is a bearish continuation, with a high probability of 65%. This outlook is reinforced by the pair being in a downtrend, printing lower highs and lower lows since late January 2026. The H4 chart shows a pronounced downtrend, with the price moving along the lower band of the Bollinger Bands, confirming seller dominance and suggesting further downside potential. A decisive break below the 1.343 support level would confirm the bearish continuation and open the path for the GBPUSD to target 1.335. This level represents a significant downside objective for sellers. The alternative bullish scenario, with a lower probability of 35%, would involve a reclaim above 1.36. However, some technical analyses suggest that a daily close above 1.3575 would be necessary to temper downside pressure, and without such a move, the path of least resistance remains lower. Immediate resistance is seen at 1.349, 1.352, which would need to be overcome for any bullish momentum to build. Considering the technical indicators and price action, the bias for GBP/USD remains moderately bearish. The consistent formation of lower highs and lower lows, coupled with the rejection of key resistance levels, suggests that sellers maintain control. While short-term fluctuations are always possible, the overarching trend points towards further downside potential. Traders should continue to monitor the 1.343 support level closely, as a break below it would likely accelerate the bearish momentum. Any rallies should be viewed with caution, as they may present opportunities for sellers to re-enter the market at more favorable prices, aligning with the prevailing bearish sentiment. Turning our attention to the USDJPY pair on the H4 chart, we observe that the price is currently consolidating inside a well-defined range. This range is characterized by clear support at 152.28 and resistance at 155.6, indicating a period of indecision and equilibrium between buyers and sellers. The primary scenario for USDJPY suggests a range rejection at the 155.6 resistance level, with a probability estimated between 55% and 60%. This implies that the market is more likely to respect the upper boundary of the range and reverse downwards, rather than breaking out to the upside. Traders should be prepared for potential selling opportunities if the price approaches this resistance zone. Should the USDJPY break below the 153.5 level, it would open the path for a retest of the 152.28 support, confirming the bearish momentum within the range. Conversely, a decisive breakout above the 155.6 resistance level would invalidate the range-bound scenario and open the path towards 157.8 and potentially even 159, with a probability of 40% to 45%. This bullish breakout would signal a significant shift in market sentiment, attracting buyers and pushing the price higher. Traders should monitor both these critical levels closely, as a clear break in either direction would provide a strong directional signal for the pair. Given the current consolidation, the USD-JPY pair is currently neutral, awaiting clear breakout confirmation from either the support or resistance levels. This period of neutrality suggests that traders should exercise patience and avoid taking strong directional bets until a definitive move is established. A breakout above 155.6 or a breakdown below 152.28 would provide the necessary clarity for a sustained directional trade. Until then, the market is likely to continue oscillating within its established boundaries, offering potential opportunities for range-bound strategies but posing risk for those seeking a clear trend. Vigilance is key in such market conditions. Now, let's analyze gold, or XAU USD, on the H4 chart. The precious metal is currently compressing between the 4,900 support level and the 5,100 resistance level, indicating a period of consolidation with no clear directional trend. This price action suggests that both buyers and sellers are in a state of equilibrium, leading to a tight trading range. The probability of range continuation is estimated at 55%, implying that gold is more likely to remain within these boundaries in the near term. Key support levels are identified around $4,960, $4,947, and $4,887, while resistance levels are at $5,022, $5,045, and $5,104, all of which will be closely watched by traders. A bullish breakout above the 5,100 resistance level has a probability of 45%, with a potential target of 5,250. Analysts suggest that a decisive move above $5,118 could trigger significant automated buying, potentially pushing the price towards $5,257 and even $5,442. Conversely, a bearish breakdown below the 4,900 support level also carries a 45% probability, targeting 4,750. Some analyses indicate that if gold encounters strong resistance around the 21-period simple moving average and the top of the downtrend channel around $4,963, it could resume its bearish cycle towards $4,685. Both scenarios present significant trading opportunities depending on which level breaks first. At present, gold offers no strong directional edge as it remains sensitive to upcoming U.S. economic data, particularly the core PCE inflation figures and broader geopolitical developments. The conflicting technical signals in the tight consolidation range suggest that the market is awaiting a significant catalyst to determine its next major move. Traders should exercise caution and consider a neutral stance until a clear breakout or breakdown occurs. The current environment is more suited for range-bound strategies, or waiting for confirmation of a new trend, rather than attempting to predict a strong directional move in the absence of clear signals. Shifting our focus to oil, specifically Brent crude, on the H4 chart, it remains the strongest trending instrument among those we are analyzing today. The price action clearly demonstrates a robust bullish trend, characterized by the consistent formation of higher highs and higher lows, which indicates strong buying pressure and sustained upward momentum. This pattern suggests that the underlying demand for oil remains strong, and market participants are confident in its continued appreciation. The current analyses for Brent crude on the H4 chart suggest a continued sharp rise after breaking above the upper boundary of a triangle pattern, further reinforcing the bullish outlook. The primary direction for oil is a bullish continuation, with a high probability estimated between 70% and 75%. This strong conviction is based on the sustained upward trajectory and the clear technical signals. A decisive break above the 67 resistance level would confirm this bullish momentum and open the path towards the 69 level. Some forecasts even anticipate an upward target of $72, with a breakout above this resistance level potentially leading to a more substantial upward movement. Traders should look for opportunities to join this established trend, keeping an eye on key support levels for potential entry points. It is important to note that only a decisive break below the 63.3 structure low would invalidate the current bullish trend for oil. This level represents a critical support point, and as long as the price remains above it, the bullish bias is maintained. While a corrective wave is always possible, with a potential pullback to 68.4, the overall trend remains firmly bullish. Global oil supply is expected to rise in 2026, with world oil demand also increasing, providing fundamental support for the current price action. Traders should use this 63.3 level as a key reference for risk management and trend validation. In our comprehensive market summary, oil clearly shows the strongest and most defined bullish structure, characterized by consistent higher highs and higher lows, indicating robust upward momentum. In contrast, both the EURUSD and GBPUSD pairs are displaying corrective bearish pressure, influenced by recent economic data and technical breakdowns, suggesting a continued struggle for upward movement. This divergence highlights the varying fundamental and technical forces at play across different currency pairs, with some exhibiting clear trends while others remain in consolidation or corrective phases. Traders should consider these distinct directional biases when formulating their strategies. Continuing our summary, the USD-JPY pair remains firmly range-bound, oscillating between its established support and resistance levels, awaiting a decisive breakout to determine its next major move. Similarly, gold is currently neutral and compressed, exhibiting no strong directional edge amid conflicting technical signals and its inherent sensitivity to upcoming economic releases and geopolitical factors. This overview underscores the importance of a multi-asset approach, recognizing that different instruments are in different stages of their market cycles, each presenting unique opportunities and risks based on their individual technical and fundamental landscapes. Finally, it is crucial to reiterate that all markets remain highly sensitive to the outcomes of the core PCE price index and GDP reports. These key economic indicators are poised to be significant catalysts, and their results will likely dictate short-term sentiment and volatility across all major currency pairs and commodities. Traders should exercise extreme caution and remain vigilant, as any unexpected deviations from current expectations could trigger rapid and substantial price movements. The interplay between inflation data and growth figures will be paramount in shaping the market's perception of the U.S. economic trajectory and the Federal Reserve's policy path, making these releases the focal point of today's trading session. That concludes today's institutional market analysis. We hope this detailed review of both fundamental and technical structures across major instruments has provided you with valuable insights for your trading decisions. Remember to always trade with a well-defined structure, adhering to your trading plan and risk management rules. Managing risk carefully is paramount to long-term success in the financial markets. Thank you for joining us, and we look forward to seeing you in our next session for another comprehensive market update. Until then, trade wisely and stay disciplined.